how we can present the NPV layout, which I showed you. So today we'll look at the question, and this question is very common in section C of your exam. Okay, so first, if you see a question like this, you need to check the requirements. So the question says, required, calculate the net present value of the investment project in nominal terms and comment on its financial acceptability. B, discuss how the capital asset pricing model can assist Hebert company in making better investment decisions with respect to its new product launch. Okay, so let's start. The question says, Hebert company is preparing to launch a new product in a new market which is outside its current business operations. The company has undertaken market research and test marketing at the cost of $500,000, as a result of which it expects the new product to be successful. So take note of this: whenever you're doing project appraisal, don't include research and test marketing. We call these as sunk costs. So costs which have already been incurred are not relevant in investment decisions. So we are going to ignore market research and test marketing. So in the exam, you need to remember to write a note to say these costs will not be included because they have already been incurred. Hebert company plans to charge a lower selling price initially and then increase the selling price on the assumption that the new product will establish itself in the new market. Forecast sales volume, selling prices, and variable costs are as follows. So we have sales volume, selling price, and variable costs per unit. Selling prices and variable costs are given here in constant price terms, in current price terms, before taking account of forecast selling price inflation of 4% per year and variable cost inflation of 5% per year. So you have to understand this word known as current. When they say they are in current price terms, they actually mean that there is no inflation at the beginning of year 0. So inflation will start from year 1. So if the examiner tells you that they're in current price terms, it means you should start inflation from year 1. When the examiner says inflation should start from year, if they will say they're in year 1 terms, it means inflation should start from year 2. Or the examiner will tell you, if they want you to start inflation from year 2, they will tell you to say inflation should start from year 2. But once they say they're in current price terms, it means you should start inflation in year 1. Okay, let's move on. Incremental fixed cost of 500 per year in current price terms would arise as a result of producing the new product. Fixed cost inflation of 8% per year is expected. The initial investment cost of production equipment for the new product will be 2.5 million, payable at the start of the first year of operation. Production ceases at the end of 4 years because the new product is expected to have become obsolete due to new technology. The production equipment will have a scrap value at the end of 4 years of 125,000 in future price terms. Investment working capital of 1.5 million will be required at the start of first year of operation. Working capital of 6% per year is expected, and working capital will be recovered in full at the end of 4 years. Hebert company pays tax of 20% per year, with the tax liability being settled in the year in which it arises. So we'll be paying tax in the same year. The company can claim tax liable depreciation on the 5% increase in balance basis on initial investment costs, adjusted in the final year of operation for balancing allowance or charge. Hebert currently has a nominal after-tax weighted average cost of capital of 12%, and they do after tax WACC of 8.5. So already given 12% as the nominal rate. The company uses its current WACC as a discount rate for investment projects. So we want to answer part A. Okay, so I'm trying to open Excel. We should look at okay, so I'll have my format of calculating NPV. Yeah, so okay, so I'll share this template later on. Okay, so this is our format that we'll be using in calculating the NPV. And move this. This should be moved. Okay, so if we go back to the format of NPV, we start from sales. We start with sales, then variable costs, then other variable costs, fixed production costs, then operating cash flow, tax paid, tax saved on capital allowances, the scrap value, initial cost, working capital, net cash flows, discount factor, then we have our present value, finally NPV. Okay. So what we want to do now is to start looking at the workings first. So I think I can